Now, Facebook translated its popularity as a social networking site into popularity with investors in its initial public offering, which valued shares at $38 each, although almost immediately the price slid around 18% to $31. Tonight, the US Senate Banking Committee said it's reviewing various issues regarding the offering. The bank Morgan Stanley, which advised Facebook, is being sued for allegedly warning some favoured big investors that future earnings were likely to be lower than previously thought, a warning smaller investors didn't receive. Joe Liner reports.
There's a reason why the people at the front of this shot are smiling. They had just all become very real billionaires. Last Friday's Facebook flotation, or IPO as it's known, was one of the biggest ever and valued the social network at over $100 billion. But the smiles have disappeared since then, and now, as with most things in America, the lawyers have taken over. Facebook and some Wall Street banks led by Morgan Stanley are being sued by a group of private investors who've lost their T-shirts since last Friday. They allege that in the run-up to the IPO, Facebook warned Morgan Stanley that things may not be as rosy as they thought. The bank is accused of passing on that information only to a select group of its Wall Street chums, instead of telling all would-be investors.
It's not clear whether anybody broke any rules. What is clear is that if they did not break rules, the rules themselves are very unfair because they gave much better information to big institutional investors than they did to small investors. Whether they actually broke the rules is probably going to be litigated now, and we'll ultimately see what the conclusion was.
It all started so well on flotation day. Shares launched at $38 and even rose a bit before closing where they started. But rumours that some key information had been withheld, as well as glitches on the Nasdaq market, started a big sell-off on Monday. And by yesterday it had closed at $31, almost a fifth down on the flotation price. The shares have rallied a bit today, closing at $32. While it's highly unlikely that fewer people will now use Facebook as a result of this IPO, its corporate reputation may have taken a knock. Facebook wants to become the medium for targeted advertising on a social network. Losing investors billions in 2 or 3 days may scare off some would-be advertisers.
To see all these shareholder lawsuits going on, to have a share price that was ramped pre-IPO and then went down afterwards, that's obviously not good from a brand point of view. Secondly, potentially longer term, and I know because this was hard for us too, is recruitment. If you've got a share price, particularly if you're in the heart of Silicon Valley where people have so much choice these days, and your share price is going down and you're no longer seen as the hot new thing, that could damage your long-term prospects because talent is everything.
So what was the vital bit of information which may have been withheld from some smaller investors before the float? When Facebook went global back in 2006, it was enjoyed mostly on large screen devices such as desktops and laptops. Adverts worked because they didn't dominate the entire page. Nowadays, we consume our social networking on handheld devices and smartphones quite a bit. There, advertising is either too small to be effective or too big that it annoys the user. And it was that fear that Facebook might not be able to get as much money from phone users that caused concern. Morgan Stanley said today that it had followed the same procedures for the Facebook offering that it follows for all IPOs, and that these procedures were in compliance with all applicable regulations. With nearly 1 billion regular users, Facebook is still the world's most valuable address book with an incredible potential. But it has been tainted a little by appearing to cozy up to Wall Street over mom and pop investors, the very people who made it a success in the first place.
Well, let's get some thoughts on this from Andrew Edgecliffe-Johnson, who's the media editor at the Financial Times in New York. And with me is Dan Wagner, who is a technology entrepreneur. Andrew, did Morgan Stanley just get this wrong?
In many ways, they did a brilliant job for their client. They got $16 billion of cash out of investors who seem to be eagerly lining up for this IPO, if you were looking at the demand last week. At the same time, the price has not sustained, and every advisor to a flotation like this wants to see what they call a pop. They want to see the shares go up maybe 10% or something and stay there and gently build up so that everybody feels happy, everybody who bought into this IPO. The difficult balance here is that a bank advising a company like Facebook is trying to two totally different things. It's trying to get the best price for the company, it's to raise as much money as possible, and for its original investors who might be selling out and trying to cash in some of the capital they put in. But it's also trying to keep the new investors happy and excited and engaged and create a good buzz around the company. And there is certainly not a good buzz around the company today. So it is a failure. It's not worked the way it's supposed to.
Dan, I mean, quite a few American newspapers have used the word botched. Do you agree with that?
Not really, no, because I think that the IPO was priced fully. It certainly was...
Oh, at the top end, you mean?
At the top end, yeah. So what happens is, typically with an IPO, is that it's book-built during the process with investor demand, and the price may get pushed up because investor demand is there to take it. And you've got to remember that these investment banks work for the institutional investors primarily because they're the ones who keep taking the new issues every time a new one comes along. So they're not going to try and stuff them with an expensive stock just because, you know, there's demand out there. They're going to try and price it as fairly as they can with the expectation that there will be an uplift in the aftermarket when people come in to buy the stock in the secondary market.
What Andrew called a pop. But do you think it's right, is it normal, for some of those more favoured big institutional investors to have information that, you know, mum and dad back home buying a few shares because they quite like Facebook doesn't get?
Well, I don't believe that they do. I mean, the SEC has very strict guidelines. You have an S1 that gets filed with the SEC. I know it was restated just prior to the IPO with new information, and it was publicised. Anyone can go to the web and download the S1 to read it in detail and see the changes. So I think that full information disclosure was out there. Whether everyone took advantage of that and leveraged that before making their investment decision is up to them, of course.
Andrew, is there a problem in this because Facebook likes to look after the little people? That's part of the image. Whether you believe that or not, that's obviously up to you. But do you think that's an image problem for them now?
I think it's difficult. Yeah, they've got 900 million users. That's what's built them up into this $100 billion company. But they've also said, you know, in that filing that Dan refers to, you know, we didn't start life trying to be a company. We started off with a social mission. We don't wake up in the morning and think about profit first. We're going to be. It's rather like when Google said, we're not your usual company. This, frankly, makes you wonder whether they could have been a little bit more like a normal company and whether they were a little amateurish in their communications. Now, there are lawsuits piling up, there are regulators lining up to look at this, and the facts of the matter of exactly who shared what information with whom are not going to be clear for a little while. And you know, what is disclosed in the court processes and in committee hearings and things like that, we have yet to find out. So there's always a bit of a grey area where the big investment banks are allowed to verbally communicate with the very big clients, to at the very least point out that that sentence in the filing is the important one to look at, where they talk about slowing mobile growth that the mum and pop investor might well have missed. So it's people involved in the IPO today are saying the information was out there for everybody to see. There was a lot of press about it. We wrote about it in the Financial Times, this sort of slowing revenue, advertising revenue growth compared to the growth in actual user numbers because of the mobile phenomenon. But it is a grey area, and it's going to take a long time to work out. But I think the other... I just want to bring him down just a second. We're running out of time. Do you think it's a problem for Facebook in the future? That
no, I don't. I think we've got to remember two things. First of all, shares go up and they go down. In this case, the shares have gone down a little bit. It's only been a couple of days. This is a business that has, you know, the most extraordinary profile. It's gone from from losses in 2008 to a profit of $1 billion. It's gone from revenues of $200 million to $3.7 billion in 3 years.
Yeah, but
it's got 900 million users. It's the third biggest economy in the third biggest.
But based on people loving what they do and loving their image and thinking this is a nice, friendly thing and it's about me connecting with my friends. If that's damaged, then they haven't got.
I don't think that's damaged.
You don't think it's
no, I don't. I think that it is a dominant player in social media, and it will remain the dominant player for some years to come.
OK, we'll leave it there. Thank you very much. Let's have a quick look now at tomorrow morning's front pages. The